Welcome to Aging Gracefully, your go-to channel for health tips, nutrition advice, and smart aging strategies. Investing money after the age of 60 requires a different approach compared to earlier decades. With retirement either approaching or already underway, financial priorities shift towards preserving wealth, generating income, and managing risk. The goal is to ensure financial stability for the remaining years while making strategic investments that align with your lifestyle and future needs. The following 10 tips will help guide your investment strategy after 60 to maximize savings and financial security. 1. Reassess your asset allocation. At 60 and beyond, your portfolio should reflect a balance between growth and security. Younger investors can afford to take more risks, but as you age, it's wise to shift towards more conservative investments. A traditional approach suggests subtracting your age from 100 to determine your stock allocation. For example, at 60, about 40% of your portfolio should be in stocks, with the remaining 60% in bonds and other lower-risk assets. However, your specific situation may require a customized approach. If you have substantial savings, you might maintain a slightly higher stock allocation for long-term growth. On the other hand, if you depend on your savings for day-to-day expenses, a more conservative strategy may be appropriate. Regularly review your portfolio to ensure it aligns with your risk tolerance and financial needs. Additionally, diversification is crucial. Investing across different asset classes, such as stocks, bonds, real estate, and commodities, reduces overall risk. Avoid putting too much money into one investment, as this could expose you to unnecessary financial danger. Working with a financial advisor can help create a strategy that optimizes both security and growth. 2. Maximize contributions to retirement accounts. Even after 60, there are still opportunities to grow your retirement savings through tax-advantaged accounts. If you are still working, maximizing contributions to your 401k or individual retirement account IRA can significantly boost your savings. The IRS allows individuals over 50 to make catch-up contributions. This means you can contribute up to $30,500 to a 401k and up to $8,000 to an IRA, including catch-up contributions. By maximizing contributions, you benefit from tax-deferred growth, meaning your money can compound without immediate taxation. If you opt for a Roth IRA or Roth 401k, your withdrawals in retirement will be tax-free, provided you meet the requirements. This can be an excellent way to secure tax-efficient income in the future. Additionally, some employers offer matching contributions, which is essentially free money that adds to your retirement savings. If you are still employed, take full advantage of this benefit. Even if you are retired, consider a part-time job to continue contributing to these accounts, ensuring a healthier financial future. 3. Diversify income streams. Relying solely on Social Security and pension payments may not provide enough financial security. Diversifying your income streams can help cushion against unexpected expenses and inflation. Options to consider include part-time work, dividend-paying stocks, rental properties, or annuities. Investing in dividend-paying stocks can provide a steady stream of passive income. Look for companies with a long history of paying and increasing dividends. Additionally, rental properties can generate a reliable monthly income if managed effectively. If you prefer a hands-off approach, real estate investment trusts, REIs, offer exposure to real estate without the hassles of property management. Another option is investing in annuities, which provide guaranteed income for life in exchange for a lump sum investment. While annuities come with fees and complexities, they can be a valuable tool for those seeking predictable income during retirement. A well-diversified income strategy reduces dependence on any single source and ensures financial stability in retirement. 4. Delay Social Security benefits. Delaying Social Security can significantly increase your monthly benefits. While you can start claiming at 62, each year you wait up to age 70 results in an 8% increase in your monthly payments. For example, if your full retirement age is 67 and you delay benefits until 70, your payments will be approximately 24% higher. This strategy is particularly useful for those in good health with a longer life expectancy. The increased benefits can provide more financial security later in life. However, if you need the income sooner, claiming earlier may be necessary. Consider consulting a financial advisor to determine the optimal time to start your benefits. 5. Establish an emergency fund. An emergency fund is crucial in retirement to cover unexpected expenses such as medical bills, home repairs, or car maintenance. Financial experts recommend setting aside at least 6 months' worth of essential expenses in a high-yield savings account or money market fund. Having a readily accessible emergency fund prevents the need to withdraw from long-term investments during market downturns. This ensures that you won't have to sell stocks or other assets at a loss. Keeping an emergency fund also reduces financial stress, allowing you to enjoy retirement with greater peace of mind. 6. Consider healthcare and long-term care costs. Healthcare expenses increase with age, making it essential to plan ahead. Medicare covers many medical costs, but does not pay for long-term care such as assisted living or nursing homes. Consider investing in long-term care insurance or setting aside dedicated funds to cover these expenses. Additionally, maintaining a health savings account, HSA, can help cover medical costs tax-free. Although you cannot contribute to an HSA after enrolling in Medicare, existing funds can still be used for qualified expenses. 7. Implement a withdrawal strategy. A sustainable withdrawal strategy ensures that you don't outlive your savings. The traditional 4% rule suggests withdrawing 4% of your retirement savings annually, adjusted for inflation. However, this may not suit everyone. Consider alternative strategies such as the bucket approach, dividing assets into short-term, medium-term, and long-term investments. The goal is to withdraw funds from conservative investments first, while allowing growth investments to appreciate over time. 8. Reevaluate insurance needs. As you age, your insurance needs change. If you no longer have dependents relying on your income, you might not need as much life insurance. On the other hand, ensuring you have adequate health, long-term care, and home insurance is essential. Reviewing and adjusting your policies can save money and ensure you have the right coverage for your current situation. 9. Engage in estate planning. Estate planning ensures that your assets are distributed according to your wishes. Creating a will, setting up trusts, and designating beneficiaries on financial accounts can prevent legal complications for your heirs. Additionally, assigning power of attorney and healthcare proxies ensures that someone you trust can manage your affairs if you become unable to do so. 10. Continue financial education. Staying informed about financial trends and investment opportunities allows you to make better decisions. Attend seminars, read books, and consult financial professionals to ensure you stay updated on best practices. Investing after 60 requires careful planning, balancing risk and security, and ensuring a stable income stream. By following these 10 tips, you can make informed financial decisions that protect your wealth, provide steady income, and ensure a comfortable and worry-free retirement.